Well, for more on the earnings season and market uncertainties, let's welcome in now Treasury Partners Chief Investment Officer. That will be Richard Saperstein. Rich, it is good to see you. So we're now in the heart of earnings season. Rich, big tech's on deck. Maybe start there, high level. What have you learned so far this earnings season? How strong, how healthy, how resilient does corporate America look?
Well, it's clearly been a very strong earnings season, and that's what kept the market up buoyant in the face of tariffs that were just announced and the Middle East tensions. But the market is choking right now on large cap tech CAPEX. And there's really three issues that the market's contending with. One is circular financing. Two is the magnitude of the CAPEX. And three is the debt that some of these companies are taking on to fund the CAPEX. Now, betting against large cap tech over the last decade has proven to be a losing trade. And we can look at, let's say, Google right now, which has $250 billion on their balance sheet and $100 billion in debt. So we're not really concerned about that leverage that they're taking on. But if you look at their operating cash flow, they've generated $240 billion over the last 12 months that they're using to reinvest back in the business. But the interesting thing is that's grown 125% in the last 3 years alone. So where is the return on this large CAPEX? It's very visible in the operating cash flow, and they're just recycling it back into their business.
And to be clear, you're overweight large cap tech. Do you think if those names, though, Rich, if they're going to now, if they're going to zap their free cash flow, if they're going to tap the debt markets, if they're really transitioning from, asset light to asset heavy businesses, does that change how, you need to value those companies as an investor?
It's definitely changing the paradigm because these companies were just having huge high operating margins and were asset light. But if you look at, let's take advertising for a second. The three largest advertisers on the planet are Google, Meta, and Amazon. Google does $300 billion, Meta $200, and Amazon $70 billion. And they're growing at anywhere from 15 to 25% a year in those numbers. And those have great margins. They're going to benefit from AI adoption. So there are industries and sectors that will have leverage, and they're using the CAPEX to actually grow that leverage. So while we're concerned about the redeployment of that money, we see great opportunity in the future once it's in place.
You like large cap tech. You also like the big banks. Now, why is that? Is that loan growth, capital returns, that deregulation? Walk us through that.
It's all of the above. So loan growth and reduced charge-offs, diversification of their revenue sources from into advisory, underwriting, trading. Their net interest margins are growing. So the banks are benefiting from the growing economy, and that'll continue right now. But keep in mind, the banks are selling at a high multiple to tangible book value. So look, it's important to own banks. They're benefiting from the growing economy, but they're still expensive relative to history, but we still like the group.
Another interesting idea you have, Rich, independent power producers. Walk me through that. Is that essentially an AI investment?
Well, really, the whole market is a vortex around AI right now.
And the economy, you could argue at this point.
Exactly. So, if you look at Goldman Sachs, a lot of their revenues derive from AI-related offerings. Anyway, independent power producers are needed because we're underpowered in this country. As new data centers come online, we're going to need power. As the economy moves more towards electrification, we're going to need more power. The independent power producers have very high operating cash flows and free cash flows, and they're uniquely positioned to service a lot of these data centers. So there's two opportunities right now. We're focused on Vistra and NRG. So we like those two names in the space.
Why those two specifically, Rich?
Because they're small, they're nimble, they have high operating cash flow, roughly 12, 13% a year. Their CAPEX is about 3 or 4%. So they're bringing down in free cash flow around 8, 9% a year, and they're using a portion of that to return to shareholders through stock buybacks and dividends.
What's your advice to fixed income investors who are listening right now?
Well, it's an excellent opportunity right now to add municipal bonds.
How come?
Well, right now you can buy long-term munis that are callable and generate roughly 4.4 to 4.6% tax-free. Now, what we're talking to clients about is the market's up 70% in 3 years. Is the overall asset allocation of each client overweight equities relative to where it should be? And so as we trim, we're moving into municipal bonds because at 4.5% tax-free for clients where the return of capital is more important than a return on capital, it's equivalent to a 9% pre-tax equivalent. So very attractive for moving some cash from at-risk to safe in this environment.
What are your expectations for the Fed this week and the rest of the year? What do you tell clients?
Possible bump of 1/4 point, only because...
Are you saying this week or at some point in 26?
In the next 2 meetings, only because I think what that's going to do is cause rates to move lower. It'll be an inverse relationship. So if the Fed bumps, the markets will get signaled that we're serious about inflation. However, I don't think the Fed has much of an impact in the end.
Why do you say that?
Because it's an earnings story. It's an AI story. And earnings growth is really dominating the market. CAPEX is dominating the AI vortex. I don't see the Fed having much impact on the market. And by the way, if the Fed does tighten, I think market goes higher on that news and rates go lower.
Rich, great to see you, especially on set. Thank you.
Thank you.
Come up.
$300